Hello and welcome to Risk at Work, Risk Connect's educational web series. I'm Scott Fenstermaker. I'm the Director of Digital Marketing. Today we're going to be talking about new trends in risk management. Don't get much of a fancy intro from me today. I'm going to let that title do the work for us. We're going to talk about some new key developments in the risk industry. We're going to talk about what we can expect to see in the near future, and a couple of opportunities for us to all improve so as to meet these trends. A couple of points of housekeeping before we get started here. If you have questions for our guest today, please put them into the question field of your webinar software. If that question does not get answered during the course of the presentation today, we will reach out to you directly with an answer from our guest. Also, if you indicated that you would like CPE credit for attending today's webinar, please watch your inbox after we're done today. We're going to send you a short quiz. You fill it out, return it to us, and we will reply back to you with your CPE credit. I would also like to mention before we get started here that we are poised to set a record today. This is going to be our best attended Risk at Work session ever. And that's thanks to all of you in the audience today. So from the bottom of our hearts and on behalf of our guest today, thank you very much for making this such a success. Thank you very much for your followership, and thank you very much for tuning into our guest today. So our guest today is going to be, once again, Ariane Chapelle. Ariane is an internationally recognized speaker, writer, educator, and advisor in operational risk management for banks like Lloyd's Banking Group. Her textbook, which I'm very happy to finally be able to hold up on camera, Operational Risk Management Best Practices in the Financial Services Industry, was named Book of the Year for Operational Risk in 2020 by Risk.net. But obviously it could just as well have easily been Book of the Year in 21, 22, 23. It's a great book. More recently, her article, Smaller Companies Must Embrace Risk Management, was published by the Harvard Business Review. It's my pleasure to have her back with us again today, Ariane Chapelle. Ariane, how are you doing?
I'm great. Thank you. Thank you, Scott, for the very kind introduction, as always. And thank you to everybody tuning in. I must say, I'm used to work in and to speak in public, but I'm a little bit stressed today, given the size of the audience. So I hope you will find this webinar interesting. And given the number of registrations we have, it shows how much people are eager to know the future. So I will do my best to at least analyze as much as possible the upcoming trends and the promising trends that we have in risk management in order to extrapolate the next few years of practice of the discipline without getting it too much wrong. Keep this webinar recorded somewhere and play it back to me in 2-3 years, and we'll see how right or wrong I was. That would be an interesting challenge. So as always, a 3x3 type of structure. So first section, where are we? What are the recent developments in the discipline? For those of you who are used to the Risk at Work webinar, you might recognize this slide. This is one of the last one I've presented recently around the changes that we've observed in the discipline over the last few years. As some of you may know, I'm active in the industry for over 2 decades, actually closer to a quarter of a century now. So the last few years is actually the recent past. And the recent past is essentially since COVID and since the boost of both technological development, and that's AI and data and models, and the regulations and attention to climate risk and ESG. And of course, I'm gonna talk about that as well. But linked to all these large, both technological transformation, geopolitical shocks, and environmental shocks, there's been a general awareness, a much better awareness in risk management, both from a personal perspective than a corporate perspective. And that had a number of consequences into the professionalization of the industry, the extended scope of applications of risk management methodology, and then a bit more observability as well, with a focus on controls, resilience. And this is very much a one-page summary of what I want to say about some of the key development in the discipline. So let me dive into, again, three main topics. I would say a generalized risk management practice. If you think of the history of enterprise risk management and non-financial risk management, you had, on the one hand, the manufacturing industry, the oil and gas, the energy company of this world, the so-called high reliable organization that had and still have, and airline companies, a very, very strong risk management practice at the first line, what's called now the first line levels, at operations level, but very much ingrained process per process. And then you had the financial industry who, again, 20 years ago was only looking at credit and market, and then liquidity, financial risk. And with the regulation of operational risk, this sector over the last 20 years has become from a pure novice to almost a sector leader, I must say, in the risk management practice. And from a, like in this the vocabulary of the three lines, for a second line of defense perspective. So a real organizations of risk management and the framework and the identification and assessment and all the tools that my colleagues and I have been talking a lot through these webinars. And you see this risk management methodology really spreading out to other sectors. And I see that in my personal experience of teaching the discipline all around the world, and now more and more across sectors, starting with the financial industry, and then the public bodies and the UN agencies and the multilateral banks of development, and now the energy companies, and now these HRO, high reliable organizations, are adding up to these very much process-based practice. You see that in the healthcare sector, which I'm also half familiar with for reasons I'll spare you. You have this process-based risk management ingrained in the business, elevated in a sense, or encapsulated into the second line. And then at a retail level, risk management has become now a daily name. However, risk literacy has still some work to do and some progress to make, but I'll get to that. And so, talking about this aggregation or this elevation of risk management practice from the operations to the second line, you observe both a professionalization and a centralization, difficult to say when you have a French accent, of risk management here. That and risk at work and Risk Connect will be happy for me to hear the notion of risk under one roof, because they obviously are a big supporter of that concept. But this concept has a true value in the market. One of my good friend specialized in risk management on the other side of the Atlantic. So I'm based in London, he's based in the US. And in the US, we observe that even more so than in Europe. I think it's clearly coming in Europe. The fact that each risk type, so whether it's third-party risk management and outsourcing and data management and model risk management and legal and compliance, etc., have information security, obviously, have all their separate risk management fraud risk management department, but all that is coordinated, or should be at least coordinated through a central framework. So you have these two different organizations. And so this harmonized framework is supposed to also highlight the clear priorities of risk management and tolerance guidance. And I say in parentheses here, at best, because despite everything I said, there's still room for improvement in what can be tolerated versus what needs to be controlled, especially for firms that are relatively new in risk management. And so third, recent evolution, but clear clear trend that we observe is moving from the risk assessment to control assessment, really. And risk are observable, controls are observable while risks are not, come very, very much from the Taleb literature, where, and you know that Nassim Taleb is a big opponent of risk assessment. And you know, without being all to that trend, we observe that also very much with regulators and with the practice of market leading firms. You don't do your risk and control self-assessment, you do your risk and control assessment. So you're not basing yourself to the speech or the sentiment of that a control is effective. There's really a requirement of control testing, a control layering, and also not only the reliance on preventative risk management. If you think about the beginning of the discipline, where we thought we could prevent everything, well, clearly the volatility of the world has shown that how this is wrong. And so there is a shift, and there's been a shift now, initially from the cybersecurity world, but then with resilience. And of course, resilience had a boost in the time of COVID, and then all the succession shocks that we have now, and climate stress is clear one as well, is the notion of how can we sustain some hard shocks rather than relying on our capacity or the lack thereof of imagining what could go wrong. And so the regulation on operational resilience is particularly demanding, with the mapping of not only third parties, because that's far too easy, but the fourth party, so the third party of the third party. And that creates very quickly a network of interdependencies that can be very complex. And again, that you cannot operate just manually. So it's not that I'm giving a shout to Risk Connect, although I do a little bit, but it's impossible with today's complexity, when you are beyond a very small firm, to respond to all these demands without a proper level of automation and data management on risk in your risk management practice. All right, so that's basically from where we're at. And so given where we're at, what it is to expect? Well, fishing with dynamite here, AI and climate, that's the, you can't miss with these two topics. This is the only two things, it seems like it's the only two things that people would want to talk about. So obviously, given the amount of interest this and regulatory burden as well that this creates, obviously these two topics are promised to be, again, replay the video in a few years, promised to be some of the main topic of conversation in, like it said on the tin, the foreseeable future for risk management. And generative AI, so the chat GPT and alike, is really a seismic change in terms of technologies. There's a lot more that could be said on the different technology platforms that are being developed at the moment, but it had and it will have a lot of impact, not only from a productivity boost, but corollary to that, a very strong business model impact, impact on all the professions that use the treatment, the simple treatment of a large value of data. And I'm thinking consultant, I'm a consultant, I can say that. Teachers, the education industry, the legal industries, there's a lot of professional services, both regulated and not regulated, that will be massively impacted by these change. I make the parallel of the evolutions of, or the apparition of Gen AI, the same way the apparition of the birth of the printing press in the 15th century, or you know, the any sorts of major technological advance, whether it's electricity to phone, rain wheel, smartphones, etc. So there's and I won't be too long on that, but from a risk management perspective, from this first bullet point, I would really encourage those listening, if you haven't done that yet, is really to question yourself of what are these new technology mean in the 1, 3, 5, and more years, but let's stop at next 5 years for the foreseeable future. What does it mean in terms of the threats and the opportunities for your business model? Because you could expect a shock to that. Now, more in the mechanics of risk management, there's a lot to be hoped and a lot to be exploited, and I'll have a chance to go back to that again. From data analytics and therefore from predictive modeling for the dissections of risk causes and risk drivers and connectivity between risks. Climate risk and ESG, I won't be long because there's so many content, but of course, both from a physical risk perspective and from a transition/regulatory risk perspective, the implications are so wide that firms will need to dedicate a lot of effort, let alone legal liability risks. I won't give you much detail, but there's a country in Europe where the regulator is imposing all the banks to draft scenarios of legal claims, the equivalent of what legal claims would be, because one of the banks is just in the middle of a lawsuit now. And so there's a regulatory demand of, well, what if it happens to you, and legal risk and the reputation towards activists is really important. We'll have a chance maybe in the near future to talk about reputation risk and measurement as well. And so another important point linked to that as well, and very much triggered by COVID, and some of you who follow me, you probably have heard me say that in the past, is that finally and we did some webinars on that together, Scott. Finally, there is, I think, a much deserved and much needed attention to tail risks, to these very large events that are not nearly as rare as we thought they were. And so we observe, but it still needs a lot of improvement. We observe a lot more rigor, and I would say reliability. They factor to that in the assessment of a scenario. I won't be long on that, but for those of you who are interested, I would refer to the other webinars I've done on the topic. But also as a personal experience, I've been working on scenario quantification for now 16 years or 17 years. And at the beginning, that was really for the tier 1 firms. But now I'm doing it more and more for the tier 2 or even tier 3 organizations. So there's a real evolution in that sense. And though finally, I'd say halfway on the forecast and also the opportunity for improvement, and that's our third topic, but it's also amazing how smaller firms now are looking at that, are the interdependencies between risks. So the notion of a portfolio of non-financial risk was an advanced notion, sort of, a few years ago. Now more and more firms are looking at that. At least they're asking themselves the questions, even so the not very large firms. And there's an interesting, I was attending a conference, speaking at a conference at University College London just before Christmas. And I've mentioned that. And there's a real attention also from the academic sector to look at the interdependencies between risk and the notion of prioritizations, your cluster of risk. But risk in the interdependency is one thing. The other aspect for better risk assessment is the assessment not of each control individually, and I've talked about the mechanics of that previously as well, but the assessment of a systems of controls, layers of controls, taking into account their independency of failure rates, and then linked to the measurement, also the data measurement of the interdependencies. That opens the way to a dynamic risk assessment. So to have a continuous integrations of new information that you get in the market incorporating rising and emerging risks. And that's, I would say, this is the more aspirational point of this slide, because everybody talks about emerging risk, but the number of companies that systematically use data monitoring and as a natural feed of the system is still a minority. So I would definitely put that as an expectation for the near future. And so on the third section, and I know Scott is piling up his questions for the end, so so I continue, but after that, it's going to be his turn to grill me. The opportunities for improvement. So before you think that, well, she's not talking about the future, let's say that I'm an optimist. Well, I am sometimes, not every day, I must admit. But today, I choose to be an optimist and think that where the market or where the risk management discipline should evolve, it will. And so first step here, risk literacy, which grosso modo is the general understanding on the main assessment of risks. So at an individual level, we all prone to recency bias and visibility bias. So we overstate the likelihood of recent events. We overstate the likelihood and the impact of very frequent event, even though they might be actually quite negligible versus the one you don't see. The general media and the news completely thrive and surf on these biases. So there's a real need for us to so for risk managers or everyone in charge of assessing risk and discussing risks and brainstorming with senior management, etc., to really get a conscious and a corrections of these bias. It's well known, but it's not tackled nearly enough now. Neglecting exposure, again, it can be very classic for some, but still weird for many, especially in the risk assessment. So what you do is you multiply the probability of an event or something going wrong by the number of times you're exposed to these transactions. So when you execute 1 million transactions a year, even with a system that is reliable at 10⁻⁶, so at 1 in a million fail, it's an expected loss of an event of 1. But if you have a system that is 99% reliable, so a failure rate of 1%, and you have 3 transactions a year, you're completely safe, or you're close to completely safe. And so this is, again, a simple trick that is not systematically integrated in the risk assessment of everyday toolkit of risk management, and definitely not the domino effect of risk dependency. So all these elements have a very large influence, or hopefully will have a very large influence on improving what Nassim Taleb says we're so poor at doing, which is assessing risks. And so once you're assessing, your risk assessment is a bit more reliable, it helps you also define better your risk appetite and your tolerances, both on incidents and on controls. Again, the natural reactions or risk appetite is I don't want a loss of data or reputation damage or dip in my revenues. No one wants negative effect. But how do you put in regards the cost of your controls versus the cost of the risk and even the cost of incidents? It's something that needs a lot more measurement, and I'll come to that. And measurement and observability and objectivity of risk, incidents and control cost is really important to highlight. What I think is still largely missing in risk management are the clear priorities. What do we let drop, and what do we focus on in order not to spread yourself too thin as a risk manager and over control everything. Data would be my also definitely I'd say risk data more than risk literacy would be my first bet in terms of the next 3 to 5, well, 1 to 5 years in risk management is a much better use of the data available, especially through AI. And AI goes way beyond ChatGPT. Artificial intelligence and machine learning, more specifically, have the ability of reading text and transforming text into exploitable data to calculate the risk drivers. And that's what's still, that it is still largely unexploited. And I've observed that over the last few years very clearly in firms. And so, well, everybody gets completely excited about Gen AI, and it is very exciting and very fun to use. I think we should be at least as excited as with the capacity of reading all the text or the need for us, for organizations to use all the textual data, the findings of audit reports, the write-ups of IT logs, the alerts in emails, the conversations. There is a number of startups working on that and really treating these data as early warning system of something going wrong in the organizations, and then improve very much the prevention of risk. And also looking at what I said, the interdependencies and the co-occurrence of risk, either because they're both triggered by a similar event or because one or the other cause each other. Again, we're very familiar with the portfolio approach in financial risk management. That's Markowitz 1953. Hopefully a century later, we won't have to wait for 100 years to have a bit of a more systematic approach for non-financial portfolio management. And finally, also in terms of data, but more qualitative data in practice, in case you're wondering what are all these points or how all these points are linked, it's more the exchange of experience. Now, in the financial sector, you have a number of data consortium, ORX being the most well-known one, that regroup members of the industry and talk about and share the practice. UN agencies have collaborations, but they underutilized, if you ask my opinion on risk management, and so is the case for development banks and central banks. I talk to quite and banking regulators that I talk to regularly. I'm less familiar with, although I have some examples of collaboration in or the lack thereof in other sectors. But again, for you listening, I would really encourage you to seek out any sort of fora of your sector representativity where you can exchange your practice, because whereas everybody thinks that their case is unique and everybody is unique, it's very sweet. But when it comes to risk management practice and problem, I see dozens of firms for decades, and pretty much everybody is facing the same challenges. So don't feel alone, and do not hesitate to share your pain or your puzzles with others. So finally, and Scott is ready to jump with his questions, I'm sure. Finally, the last opportunity for improvement is in the acceptance and the optimizations of risk management. And I'm sure that a majority of you listening, especially if you work in the second line, will find that they don't receive enough love from the business. One of the biggest challenges since inception is for a risk manager to be accepted, to be popular, to be listened to have the business complying to all the technicalities of collecting KRIs and being compliant with the regulations and completing the RCSAs. And how do I convince these people? And it comes from two things. It comes from objectivity and visibility of the costs and benefits of risk management, and therefore on the proper prioritizations of risk management. And especially in the regulated industry, and the one I know best is the financial sector, risk management had it very easy at the beginning because they say you must do that because the regulator says so. And this argument had basically allowed the risk management to not build a business case for risk management. I wrote a paper a few years ago on that, build a business case for risk management. Imagine there's no regulation. What's the cost benefit? What is the cost of what you asked me to do in terms of building up a risk management function, with the time spent and the tools and all the FT is dedicated to that versus the benefit from the business. And so there's been still now a tremendous lack of measurement of the benefits of risk management. And the typical question is, we can't measure what we've avoided. It's true to a certain case, but there are ways, but I'm not going to anticipate because I'm sure Scott will be keen to discuss that in more detail. But I would say there's two parts. One is the measurement of the real impact of incidents, and the non-financial impact are very financial and can be measured: reputation, customer satisfaction, regulatory scrutiny, internal remediation costs, deviations of management attention, all that deserve more than a rating 1, 2, 3, 4 and a color, but actually millions of dollars or euros or yens or whatever in front of the incidents. So that's on the cost side. And so on the benefit side, it's the benefits of stability and better performance of the business. And so I would really encourage you for the next 3 to 5 years, for you in your individual firms listening, to really dedicate enough attention to the quantifications of all this in order to build a powerful business case for risk management and therefore optimizing your function.
Wonderfully done, Ariane. Thank you so much. And we have a good, robust time for a couple of questions here. So I think that was going to lead to a wonderful discussion. A couple of things that just came up to mind right now as you were discussing, particularly on this third slide. Um, I want to ask you about what you're seeing in terms of the trends around general attitude towards risk management. You said some of this up early on, but drove that point home when you were talking about the quantification of the value of risk management. You may or may not be familiar with the 90s movie Office Space, but it features some stereotypes of what tech firms were like back then. There was one particular character who was a big fan of having a red stapler, and he was kind of a mousy little dude, and the big boss would just put him in the basement or the closet or wherever that was. And up until recently, that kind of encapsulates an executive leadership attitude towards risk management, right? Where it started out saying, okay, I'm the executive leader. I'm going to go out and have all the fun and take all the credit for corporate strategy. You guys get in the closet and just make sure I don't get surprised by anything, right? This is speaking to operational risks specifically. I have seen more evidence, and there seems to be more evidence that as we progress, particularly in the post-COVID era, in the last couple of years, that there is a more, or could be a more welcoming attitude of executive leadership to risk management at the executive conversation level, right? The rise of the CRO in non-financial risk, for example, and the idea that risk, rather than being thought of as a way to not get surprised by something, as a risk mitigation function entirely, is now more thought of as, or more properly thought of as, a function that allows you a higher probability of achieving your strategic goals as a company, right? Given uncertainty, how can I maximize the chances of of our company accomplishing their goals for this year or this 5 years? And that's where risk management actually has its most impact. Can you comment on any evolution of attitudes generally towards operational risk management in like the past 3 to 5 years, whether or not you're seeing some of these same things and the evolving relationship between risk management and the executive leadership team.
Yes, sure. So over the last 3 to 5 years, I would put that in the category of improved risk awareness,
Mhm.
and improved, yes, and generalized risk management practice. So I think that's clearly a positive evolution, where sadly COVID helped, and every crisis helps risk management, right? Whether it's a geopolitical incidents or a climate or whatever, or change in technology, every crisis helps risk management. And let's not kid ourselves, regulation has been a tremendous driver, and we observe that with the climate regulation, because no one cares until it's regulated, right? And it's true in the US, it's true the same way in Europe, and the regulators knows that full well. So I would like to say that, people saw the light, but no, they saw the regulator before they saw any specific light. But that's for, sorry, and then I'll get back to being serious. But
That's so true.
you're a good
That's so true.
audience,
I'm
so I
sorry.
like I
That's so
like
true.
working with you. But there's definitely a better acceptance of risk management now on a more positive, on a more upside, and that's the no downside, basically. Okay. And you're right. The no surprise is basically doing risk management to avoid the downside.
Mhm.
What I observe in some firms, and I wish it generalized, and it's a little bit what I've done when the HBR paper, it's totally what I've done with the HBR paper on positive risk management, is risk
Mhm.
management so you can take on the upside.
Right.
And um, all the seism that we see now with Gen AI, for instance, and all these shocks we have to the economy, and the volatility, ambient volatility, really should encourage you to take risks. And the better, and I've said that when we had our talk on positive risk management, the better you are at risk management, the more you can take on risk. And when a firm, is undergoing a large acquisition, or it's simply growing, if you're growing 10% a year, just that, and startups grow a lot more, and I know Risk Connect is growing and acquiring firms, etc. And BDO I work for is acquiring firm every year. It was me, and then there's lots of other little me after that. You need to be, that means more risk, more uncertainty, bigger business, bigger coordination cost, bigger complexity. So you
Yeah.
have an exponential evolution. It's not philosophical, it's mechanically, you increase exponentially the complexity of your firm. And so you exponentially increase the number of chances of individual transactions or individual things going
Yeah.
wrong. And so if you want to grow, you have to um, upgrade really your risk management practice. And when I teach on risk appetite, I say that a lot, and not everybody had necessarily thought about it before. I say, when you talk to your board or to your committee, your executive committee, and they say, we want to grow by 20% next year, you say, great, but my operational loss budget needs to grow by at least 20% for next year. Okay.
Right.
Because things will fall more proportionally unless there's a real change in quantum really in your risk management practice. So going back to what you said, yes, it's more accepted by risk managers, but I think one of the evolution I wish, and I'm encouraged to see, because this paper you're referring to on positive risk management is working really, really well.
Mhm.
I wish that risk management is evolving in the form of, I'm going to brace myself, or I'm going to equip myself to capture more of the upside rather
Yep.
than the only avoiding surprises.
That point you made on bigger organizations and more complexity is so important. And I feel like sometimes we make the point on complexity and interdependence, and people just kind of nod their heads and nod along without necessarily realizing how opposed that that is to things like um largeness and newness and so forth. In other words, people want the benefits of having a very large organization. They want the benefits of having the latest in technology and the best vendors and so without realizing that the more that they scale up, the more that they have a whole bunch of vendors that are meeting on a project and so forth, the opportunities for failure are going up exponentially compared to how big they're growing. And you see a lot of project risk management right now where they say, well, we want this to have the absolute latest in technology, not fully comprehending that you're bringing in all the potential failures that come along with that. So I want people to hear you say that and understand that the risk mitigation, just what you said, the risks that come along with that are serious, and they grow exponentially with size, with newness, with the ability that with central planning as opposed to diversified planning, and having processes evolve. All of these things have risk tolerances that or risk fragility curves that are exponential. And so I want to highlight what you said on that. Let's talk about culture and literacy for a second. What constitutes in your mind good risk literacy? You hammered that home. We should have good risk literacy. If I'm looking around my department, how do I know whether or not my department, my organization is good or not?
Um, I would have simple challenges. So at corporate level, I would have simple challenges with risk and control self-assessment.
Okay.
And the same way you were talking about centralized planning versus fragmented planning, and I think
Yes.
it's very interesting also, and that goes back to anti-fragility. I think that in one way you want your operations to be sort of diversified, the same way you want your risk to be diversified. But I think the role, if there is an important role of the second line, so of the risk managers, is to provide this overarching method and challenge, but challenge not in being a pain, but challenge in terms of sounding boards on the worries and priorities and risk acceptance of the business.
Mhm.
So it's really checking if when a manager accepts a risk or relies on a control, he
Mhm.
does that on a real information. And so again, apologies if you heard that example in a different webinar, but I was discussing with a payment services that was assessing the risk of payment error and was executing 7 million of payment a year. I say, well, on manual processes, if you account a 1 in 1,000 error, your budget for the year is 7,000. And so the volatility should be on, is that, given that's my expected loss, what's the volatility around my expected loss?
Sure.
That would be the sort of literacy. Feeding back, also something I've mentioned later, looking at what you've assessed in the past and how these risk assessments have sustained the passage of time. The same way I said, if you want to assess my provision, go back to this video in 3 years' times and see what was right and that was wrong. No, but this feeding back on results is part of the continuous improvement of risk management, because what I observe, and I haven't mentioned that in the opportunities for improvement, but what I observe over and over again is that people do things and build expectations in risk assessment, but rarely look back if their control assessment were reliable, their risk assessments were reliable. So that would be the role, that is actually the role of the second line, is to provide this consistency. The notion of everything I mentioned around the risk dependencies, the control dependencies. I had discussions even still with an IT security team at a firm not so long ago. And I was talking about the independence of control. I was like, don't waste your time assessing each control individually if they all fail at the same time or they all succeed at the same time, because
Right.
the dependency rate, the dependency between the failure rates of your control is way more influential than the reliability of each control individually. And it's still mind-blowing the amount of people that do not take that into account. So these are these sort of simple rules of risk assessment that I wish each risk function has and really instill in the business without, doing complicated math.
I remember the Swiss cheese example from a webinar that you did before where the holes line up and the risk gets through. Um, for those of you who may not have seen that past webinar that we did, this is a good opportunity. Can you remind us a little bit of what you mean by considering your assessments in a portfolio view of assessments?
Yes, so let's take three examples of controls, each key, each with the capacity to stop an incident. And imagine they all fail at 10% of the time. Now, if
Mhm.
they all fail independently, it's like rolling a dice with 10 faces. The likelihood of these whole being aligned would be 10% to the power of 3. Okay, 1 in 10 times 1 in 10 times 1 in 10, that's 1 in 1,000. So this process is 99% reliable. If the controls all fail at the same time or all succeed at the same time because it's one guy who does a manual process, and if he's not there to press the button, the project fail, or if
Right.
he's distracted on all these verification, or if the guard at the entrance doesn't press the button, all the others controls can't take place, etc. You have this sort of full dependency effect. The reliability of your system stays at 10%. So 90% reliable. So you have 90 versus 99.9. So you have a ratio of 1 to 100 in the reliability of these two systems if you don't consider the dependencies between controls.
That's very important. We were talking earlier, but before we got started on the webinar, our engineer was talking about how he has redundant internet systems to keep, if one goes down, then the other stays up. And they happen to be doing some enhancement work around the infrastructure in his area. And sure enough, both of those went down at the same time because at a certain level they were codependent on one another,
Mm.
right? At a certain level, when you cut a wire, you cut a wire. And so, um, the examples of these things are frightfully easy and are not just in the corporate arena, but I suspect it's very easy to believe that your controls are more independent than they actually are.
Well, the first thing is to be conscious of it. And I know many
Mhm.
people who are completely oblivious to it. So that's one point. But the other, and going back to the importance of data, the other element is once you know it, it's really to make sure that your system integrates these parameters. And in the days of resilience and the regulations of resilience on operational resilience across all sector, there is a real need for firms to identify the single point of failure, to identify the dependencies on the redundancies they have, and to really build solid organization, especially for your critical system. Again, I am not saying that you need the braces, the suspender, and the parachute for absolutely everything you need to do. And that's very much around the prioritizations of risk management. What do you
Mhm.
let drop? And what do you really pay attention to? And so that's also comes into identifying what are the critical aspects of your business model. Um,
I tried to avoid talking about AI for as long as I could, but yeah, let's talk about AI for just a little bit. we you mentioned AI technology as it advances being helpful in risk management, having to do with the data opportunities that you presented to us. Where are you seeing this now, and where do you foresee advances in AI having the most impact on our ability to manage risk?
oh, That's
Let's start with where are you seeing now? Where are people where are people looking for I imagine for data mining, you know, for being
yeah,
able to collate a lot
yeah.
of data and being able to surface it and report it and stuff like that. Where are people experimenting with AI and risk management?
Um, Look, I would say I won't be able to answer. I can only answer anecdotally because it is
Sure.
anecdotally because there's so much. I would start by saying it's very sector dependent.
Hmm.
And therefore it depends on who you talk to and on very different examples. When you talk to cybersecurity specialists, they're going to tell you about the risk of cyber attacks and better phishing emails and ID theft and fake voice and fake ideas, etc. So in terms of risk, elevated risk, there's a huge area uh, of cybersecurity. So that's
Sure.
one aspect. Completely different in the medical sector. And generally, any sorts of decision that requires it's a simple decision, like a yes/no decision on a very large sample of data.
Hmm.
You have a lot of advanced, I've been told, so I haven't, don't quote me on this really because I haven't checked, but that there are applications that are more reliable than dermatologists to detect potential skin melanoma.
I see.
And so at personal risk man, and I was at an AI, fine, it wasn't anything, it was an AI workshop. So it's not, the guy on the street that told me that. But anyway, I need to check that to investigate these apps. But, and actually it makes sense because what the computer does is that it compares the spot you have on your skin. Everybody can download it. You can check your nevus, if well, not you, but I'm talking in general.
Hmm.
Um, and because the bank is not a doctor, not a human with this limited knowledge, data bank, if you want, you can
Hmm.
compare that to a lot more data. And
Sure.
so anything that requires a comparisons to a very large data set could improve decision making. And so if I extend this example of potential skin melanoma, and there are lots of applications in medicine, you can very much improve decision making through the corrections of the biases I've mentioned, which are, let's see where
Sure.
they are, the recency bias and the visibility bias, because you don't rely on a human memory, but you rely on a very cold and objective database. So that would be my 2 seconds answer for today on that one.
Last area I wanted to get into, but on your third slide of opportunities there, we could do a whole webinar on this, and I won't make you do that right now. But the idea of evidencing the benefits of risk management, which I'm sure a lot of people in the audience have said, yes, that's a great idea, but how, right? You mentioned that, yes, you cannot quantify that which you avoided, right?
Mhm.
But that's true. You cannot quantify that which you avoided. And when you're speaking to a skeptical executive leadership team who thinks that you're a cost base rather than a revenue base, and you're saying, yes, but look at all these long tail catastrophes we avoided. Well, how did we know that we really avoided them or not? Paint me a picture of how people can think about getting started, really evidencing the benefits of non-financial risk management.
Okay. Well, I would base the answer on the two keywords here: performance and stability. And
Hmm.
performance is basically the capacity to achieve objectives. And you said that in the evolutions of the view of the risk, when it moved from avoiding surprises to having a better chance of achieving your objectives. And so I linked that to the ambition of a firm, or it can be an individual. The more ambitious your goal is, the more usually risky or uncertain it is in its in achievement, and therefore the better you need risk management in order to perform. So you embark on a complex project because for a bank, you change your core banking system, or you acquire a competitor that is about your size and you have a massive M&A to digest, or you open operations in a countries you've never been operating before. These are ambitious goals with a business plan and very nice, shiny Excel spreadsheet that have been dragged on a 15% growth rates every year for the next 15 years. But what will give you a capacity to actually perform alongside these business plan rather than failing because something comes out of the blue? That's risk management. So no, in a sense, it's unavoidable to prove what you've avoided. That's poor
Right.
choice of word. You cannot prove what you've avoided, but you can prove what you've reached. And systematically, so you can be lucky once, but it's less and less likely that you're lucky every year or every quarter in a row. That's one aspect.
Okay.
And the other instability, that a lot of that is peer comparison. What are you doing compared to what your competitors are doing? Are you in the press for the wrong reason compared to your peers, etc., etc.? It's very much a sample, sort of peer-to-peer sampling. And then finally, you can look at the before and after, which I've done. Some firms have asked me to do a baseline for their risk management practice. And what we've done is that we observed what they were doing in terms of incidence and stability of the revenues, etc., before they revised their framework and after, and see what the change were. And these are simple exercise, but they're insufficiently done for the reason you mentioned. People say, oh, I can't prove I've avoided, so I'm cursed.
And I mean, I think we'll have you to talk about this at a future date, but there are ways to quantify even things like reputational risk, are there not? That most people think. I'm not going to ask you to go into the details of that now, but can these things be quantified and thought about that way?
Yes. Alors, the calculation, the assessment of reputation, or the so-called non-financial impacts, are suffer from the same bad press, in a sense, or the same discouragement of, oh, we can't measure it, and it's vaguely measured as the name in the press or in the general press. When you
Right.
look at, I spent a summer looking in detail on that, and I have a little model, anyway, approach. So we'll talk about that at a later stage. But when you look at the academic literature on reputation, it insists on the multidimensional nature of reputation. So it's reputation to whom and reputation about what. So reputation to whom, and I won't be into detail, but is who are your key stakeholders? Who do you need to satisfy, in a sense? Or when you have a given impact, how does it impact your stakeholders? Does it impact your regulator, your client, the general press? But can the general press impact your business? Maybe if you're retail, but if you're B2B, probably not. What's the volatility of your stakeholders? So can a customer leave you or not? Now, if you're a fintech bank and you swap accounts very quickly, that's fine. If you're a mortgage company, people won't change their mortgage because you're in the press for something that doesn't relate to them. So your customer are a lot more sticky. Your third parties, your employees, I don't know, but I don't know if you know, where I tell you, but there was a very interesting study from the Reputation Institute that says that companies that are hit by by large incidents, by reputation damage, are 46% less likely to be able to hire talent. That has a
Right.
massive impact. If you
Right.
cannot hire the people you want, and Harvard Business School or Harvard Law Schools or all the universities live and die on their reputation by attracting good teachers and good students. Okay, and that was the very famous quote of their Harvard chairman many moons ago, and saying, we hire the best and we're trying not to ruin them by the time they graduate. But it's exactly how university work. It's the select. Sorry, hi UCL and ULB and everybody, but that's very much the selection bias. And the number one driver of performance of firm is the quality of their staff. And yet it's surprising how little, actually I've never seen it, except when I wrote about it. But I've never seen a firm that highlighted as a reputation cost the cost of decreased HR quality, staff quality,
Sure.
really, because senior management leave, and having said that, a lot of firms that suffered very large reputation damage or significant operational risk incidents have seen managers leaving by the dozens. Really, I'm thinking large banks
Yeah.
a few years ago.
Well, Ariane, we're at the end of our time now. You've given us a lot to think about. Thank you very much for coming back to Risk at Work and talking about these topics. And I want to thank our audience for spending some time with us. And we will see you next time for our next session of Risk at Work. Take care.